What are we talking about?
We're going to talk about some real estate, like
Yes.
we always talk about, and we're going to talk about BRRRR investing or value-add zero money down investing versus turnkey investing or putting money down or paying for houses in cash.
Well, I think the overall arching strategy of everything we talk about, though, is real estate's the place for your money.
Yeah.
And today we're going to talk about if you have some excess capital, whether you're a high income earner, whether you have a ton of equity in your house, whatever that looks like, you have access to a big chunk of cash or ongoing big chunks of cash, how even doing that or even investing in real estate using that strategy is still the best place to put it. And then obviously we talk about how to do it with no money down or other people's money.
It's always about leveraging what you have, right? When we started building our portfolio, we're young, we're hungry, we got energy, so we had hustle. And that's why we're able to go scrap and find deals at a discount. So that was the value add investing that we did. But as we get older and as other people mature into their careers and start earning disposable income, they leverage their money so they can put that to work for them so they don't have to work and hustle and do all that stuff that we did when we were younger.
Yeah, they need to get their money in real estate, and if they don't have the time, they have the extra money, the best place to put it is with somebody that can use it in real estate.
Yeah, because real estate in general, I believe we've had episodes that talk about what's the best investment, right? Is it Bitcoin? Is it stocks? Is it, what were the other option? Buying businesses, small businesses in real estate. And I believe real estate is the best investment vehicle.
Yes.
Do you still believe that, Sam?
I still believe it 100%. And I think before this episode, most people probably understand that, but after this episode, they definitely will. So let's get into it. This episode is brought to you by
FasterFreedom Capital,
which is our hard money lending company, as well as our long-term DSCR lending company. Rates are the best in the country. So if you're looking for fix and flip loans or long-term 30-year DSCRs, we got you.
30-year fixed loans we have on rental properties. That wasn't even a thing 5 years ago.
We got 20 was the most we could get when we started.
Yep. So now you're getting 30-year AMs and great interest rates. As good of interest rates, it's if not slightly better than you can get on your personal house right now.
Yeah, it's wild. So if you need the money and cash flow is tight because of prices and interest rates and cost of owning, getting cheaper money is a huge solution.
Huge part.
A ton of our community members are using it. So that being said, Lucas, why don't you talk a little bit about what is BRRRR investing?
Yeah, BRRRRs, whatever you want to talk.
The effing method, whatever you want to call it.
BRRRRs, on our first house we ever bought. Remember that street?
I do. Saturn.
Do we still own that house?
We still do, yes.
We still do. But we didn't even know what the BRRRR strategy was.
We did not.
We were going to fix and flip it, right? And take that money and put it down on a turnkey property. That was our plan. And then we figured out what the BRRRRs was and value add. So you got to buy a property at a discount. So that's what the B stands for, right? And then you rehab that property. That's the first R. And then you rent the property out, start getting that cash flow, and then you take it to a bank and refinance that property. That's what BRRRR stands for.
Yeah, and you can use your own money to do that because you get it back on the refinance. You can put your own cash into a purchase, put your own cash into a rehab, have a big chunk of money in the deal. You can leave it in there. Naturally, you're not going to have a loan payment or principal and interest, so your payment's going to be low, your cash flow a ton. Or you can refinance it based on the new value and pull all of your money out plus interest, and you can kind of feed yourself and be the bank.
Yeah.
Or you can borrow other people's money to do that, and the interest goes to them and not to you. So there's a lot of different ways to slice it, but that's the way to do it from soup to nuts if you want to start with the distressed property.
Yeah, I love that. And it all starts with that distressed property with the BRRRR. If you don't have that, if you're buying turnkey stuff, you can't BRRRR it. This whole strategy doesn't work. And if you buy too high, it doesn't work. But forcing appreciation, let's talk about that, the rehab side
Real
of things.
quick.
Yeah, go ahead.
What does soup to nuts mean? Like, it means beginning to end, but why would that be a thing? Like,
Soup to nuts.
That's a saying, correct? We might soup to
look
nuts.
up soup
You know
to
what soup to
nuts.
nuts means,
Yeah,
right?
I've heard the saying.
Yeah, but why, like, nuts and
how
bolts?
does it start with soup, and how does it end up with nuts?
Yeah, so I would assume maybe it means like the food nuts, but I don't know.
Do you want the explanation of,
Yes.
of soup to nuts?
Yes.
It means from the beginning to the end or covering everything complete.
Yeah, but
Yeah.
why is it soup and nuts? My fast chat that. Like, why do they use the word soup and nuts?
Phrase comes from the custom of serving soup at the beginning of a multi-course meal and nuts as the final course.
Okay, that makes a lot of sense.
That makes a lot of
actually.
sense. I did not know they serve nuts at the end of fancy meals.
Like a dessert of some sort, like a pecan pie.
Yeah, that could be, or like, like roasted with some like cinnamon and glazed like
really good.
walnuts.
Yeah, that sounds walnuts. I
Is
don't
that-
know if you eat walnuts.
Do you not eat walnuts?
Yeah, I don't know. I used to hit them with a baseball bat back in the day. It
Yeah,
used to be our baseball when I was
Yeah,
a kid.
I can remember that. Okay, all right, back to it. So, You were talking about.
By the way, shout out to Brendan. That's Brendan on the one.
that was Brendan's on his one. That was his first. That was his shining moment.
Yeah.
Make sure your mom listens to this, okay? All right. So we're talking about forcing appreciation. That what you're talking about?
Yeah, and it all starts with buying it right. So if you see a property that needs work, they're everywhere. We like to buy them off market, but there's a lot of properties that need work that are on the MLS, right? And we got to figure out what it's going to be worth after it's fixed up. So say a house is worth $200,000 and needs $50,000. That house is not selling for $150,000.
No,
because nobody is going to buy it for $150,000, spend $50,000 for it to be worth what you have in it. Might as well just buy a house that's worth $200,000 that's already fixed up at that point. So there's discounts out there that you're able to get because people need to sell these houses and not going to be able to sell it for what you have in it, like I just talked about. So our formula is after repair value, after it's fixed
ARV.
up, ARV times 75%, that is our discount factor, minus the repairs. So we would purchase that house for $100,000 because it's 200 times 0.75 is 150 minus $50,000 repair. $100,000 is what you want to purchase that house for, and then you force that appreciation by rehabbing it, spending $50,000. You're all in for $150,000, and now your house is worth $200,000.
And then you have $50,000 in equity, or $40,000 maybe if you're doing a refinance with the bank. But in general, it just allows you to get in a really, really good position with using some of your money now and getting it back, or using somebody else's money. And the beautiful thing about this method, Lucas, is you have a freshly rehabbed property, which is going to attract the best tenants, which is going to give you the most cash flow, which is going to give you the least amount of headaches, and which is going to give you the least amount of maintenance and turnover, which means more money in your pocket. It's just a beautiful side note of repairing a property rather than buying a property that already has a tenant in it, or a property that's maybe rent ready that just needs a little bit of work.
Yep. So you buy it, you fix it up, then you rent it out. You attract that awesome tenant that Sam's talking about for that highest amount of rent because you got a beautifully rehabbed property. And after that is refinance. So what do you do in that part? How do you go back and pay the private lender back or get that equity?
So you go to either a small local bank or a DSCR lender like FasterFreedom Capital that we talked about, and they're going to appraise the property, and they're going to their own ARV. I guess it's RV, or it's after repair value, it's current market value because it's already repaired. So they're going to look at the actual market value, I think AMV, but regardless, they're going to look at the current value of the property, and they're going to give you a loan for 75 to 80% of it. If you have it owned in cash, there's no loan on it, either, no loan with the city or the county, and then you can use that cash that you get from the refinance and pay back who you borrow the money from. And boom, now you only owe the bank or the DSCR lender money, but you're collecting rent, and the rent pays them back over the next 20, 25, 30 years.
Absolutely.
So it's a slow building wealth tool. Not really that slow, but slower than, 2 years. You're not going to be wealthy in 2 years. But
Yeah. I think we bought our first rental property when we were 26, and our goal was, or my goal was like, hey, I want to be a millionaire by the time I'm 30, and using this method did that.
Yes,
so
it did.
Pretty cool.
Yeah, becoming a millionaire, probably multi-millionaire by the age of 30.
Yeah.
Because of leverage and real estate and the methods that we went through. So it does happen quickly. Like realistically, you're going to create more wealth from one rental property than a 401k and an IRA combined.
Isn't that crazy?
I just did a video on that today. It's not, nobody's really watching it yet. So we'll look at that, but it's just the power of it is insane. You're not going to get that anywhere else, especially because, just to put it plainly, if you want to own $200,000 in stocks, you need to put $200,000. If you want to own $200,000 in Bitcoin, you have to put $200,000 in. But if you want to own a $200,000 house, you can put 20% down, or you can do this method and have no money into it.
And that's one of the biggest one of my favorite benefits of the BRRRR investing is we were able to go from 26 to 30 years old and buy a ton of these during that time frame. I don't remember how many it was during
Probably
that
around
time frame.
100, 75 to 100.
Yeah. And we did it all without any of our money. So you can, if you get really good at finding these houses and rehabbing these houses and relationships with private lenders on the front end and relationships with local banks on the back end, you can really scale this thing fast because your cash is not your limiting factor because it's not needed.
Yeah, and a lot of people don't have it. Like if
we didn't.
If we were to use our own money, we would not own $50 million in real estate. We would probably own $5 million in real estate, maybe.
Yeah, we'd own more than that. We'd figure out a way. But Yeah.
using our own money, I guess we'd have to
Yeah.
do a lot more work though to get the down payments.
Absolutely, yeah. We would have to get very creative, and this way can outscale any other way for sure.
So let's move on to
That's the benefits.
the turnkey side.
Couple risks
Okay, what are the risks?
those
Okay.
too. So I mean, number one, finding these deals is challenging. I told you those numbers. 200 grand house times 0.75 minus 50. You have to buy it for $100,000. Those deals don't just fall off.
50% of
tree.
the future value. Yeah.
Yeah, that's so the deals are hard to find, and then you got to do a $50,000 rehab. That's not the easiest thing to do in the world.
No, because rehabbing can be scary because small mistakes in rehabs can cost you a lot of money and time.
Yeah, absolutely, and there's a lot of mistakes, especially when you're beginning, that can happen. And you could be doing the work and do it wrong, or hire the wrong contractor and overpay. There's a lot of risk on a rehab, no doubt.
Even if you don't make mistakes, it probably is going to take you twice as long as it should have. And if you're borrowing money, your money cost doubled when it didn't have to.
Yep, and on the back end, you gotta make sure your numbers are dialed in. That $200,000 mark. What happens if the bank comes back and says 180? You got some thinking to do. You got some figuring out to do, and then you got to have those relationships, good credit score, and be qualified for that refinance as well. So there's a lot of moving parts with a BRRRR. You got the upfront financing, you got the acquisition, you got the rehab, you got the tenant, then you got the back end refinance. So for one deal, it's a lot of moving parts.
But if you don't have the money, it's your only option.
It's your only option. So I'm just talking about some of the downsides
for sure.
to why people wouldn't want to do this method. It gets a little messy, and it's hard to scale efficiently if you don't have your systems dialed in.
Especially if you're busy and have a job and have things going on and a family, and you don't want to spend 20 hours a weekend like we did 100%. For a year and a half before we had kids.
Exactly.
And nights.
Thank
and
God
all
we
these.
started when we did, right?
So
cool.
So there's that side of it. That's for the hustler, the grinder, the person that's willing to follow a system and process and that has some free time. And obviously we have a community that teaches people how to do it efficiently, but you still need time.
Yeah.
Now there is a big chunk of people, Lucas, that we know and talk to that have money. They have a good high W-2 paying job, and they don't want to put it on the stock market. They believe the stock market is overpriced. We're obviously due for some type of correction.
Yeah.
Or they just want to put it somewhere that's a little bit longer term that gives them tax savings and things like that. So what type of investing would that person do?
Yeah, that's more on the turnkey side. So they don't have to deal with the rehab. They don't have to deal with finding an extremely discounted property. And they can just kind of jump right into a rental property and put some money down, whether it's 20, 25, 30%, or heck, some people buy cash, because even buying 100% cash is a good place to put that cash.
Yes.
So that's what the turnkey investing would be in my eyes.
Yep. So it's already done, and
Yeah.
somebody's either doing it for you or they do it and then you buy it from them.
Yeah, there's a lot of different ways. Like turnkey's kind of broad, right? You can buy a house that's already rented. It's already cash flowing right now. You could buy a house that doesn't need much work, and then you place the tenant. Still a lot less work than the BRRRR. And then you could buy you could buy a house and do a little rehab if you wanted as well. But you're not buying a distressed property most of the time and getting these significant discounts, because there's no, because they're not a distressed house or seller probably as well.
And I feel like you're probably able to move faster.
Oh yeah.
At the beginning.
Yeah.
But cash can potentially slow you down.
You can move as fast as much cash you have on this. So leverage is still part of the play here.
Yes.
Because it's real estate. So you can get that $200,000 asset by putting 50 grand
down,
which is an amazing thing. And you can buy, you don't have to have 200 grand. You can buy 4 houses with 200 grand and have $1 million portfolio, just like this.
You got to find the properties and be able to manage it, but yeah.
But yeah, those houses are out there, and you got to make sure they cash flow and stuff. And to me, that's one of the risks of the BRRRR investing is you're financed pretty heavily. And then the cash flow is limited at the very beginning, right? Whereas your rate of return, your cash on cash percentage is pretty high because you don't have any cash in it, sometimes infinite, but your actual gross amount of cash flow is limited. We try to get about $200 a month, which seems crazy for a $200,000 thing, but if you put in chunks of money down, you're going to have higher cash flow, lower cash on cash return, but higher cash flow in total.
Yep, for sure. And it's not just should not be just about your cash on cash return. It should be about the equity growth, the net worth growth through appreciation, through debt pay down, through tax savings. There's just so many more benefits than just cash flow with real estate, which I don't know that we're getting into all that, but there's way more advantages to real estate than just the cash flow.
No doubt. And I think how I would teach someone to buy a turnkey asset, like we talked about this $200,000 house, I wouldn't let somebody pay $200,000 for the house. Even if the cash flow numbers looks good, I would still want some sort of discount to build in some buffer there.
Yeah, you want to have some equity.
And I think I would probably run it around 90%. We run our distressed property 75%, probably run our turnkey around 90%. So we can those deals are out there. And maybe you need to put $5,000 in it to fix it up, spruce it up, but you can get something at a 10% discount a lot easier than you can at a 50% discount.
And you're building in equity, and it is something that, you're it's like buying an Amazon stock at 90 cents on the dollar. It's a really good investment.
Yeah, so you already got $20,000 equity built in, plus your financing, so you get the debt pay down, you get the appreciation, you get the tax benefits, and your cash flow is going to be really good.
Yep, I like it. So some of the benefits of turnkey, the first one is it's pretty passive.
Yeah.
Even if you're somewhat involved, it's not near as intensive as the BRRRR method, and you can literally just pay somebody to do this when you probably can't really pay somebody to do the BRRRR method. So the passiveness is nice. If you're busy and got a family and a demanding job, making good money, you want to be in real estate.
Yeah.
I think most of your investments should be real estate, but at least a section of it to diversify. So the fact that it can be as passive as a stock market investing, if you have the right person, is a huge benefit.
Yeah. I think real estate in general, whether it's the BRRRR method or the turnkey or Airbnbs or whatever, there's two main things that matter in every strategy. You have to buy it right, and you have to manage it right. And if you don't do either of those things, none of these work.
Yes.
Right? So they talk about being passive. You have to make sure you hire an excellent property management company to get excellent tenants in there, to make sure they pay on time, because the numbers look great on paper, but it's not always like that. If you
when it goes to the streets.
Yeah, if you got a crappy tenant in there with a crappy management company that doesn't care about you.
Yep, and it can be less stressful as well, because there's so many different variables to make a successful BRRRR deal.
Yeah.
You're looking at it, it's already done the rehab. You've already is it going to appraise for what I need it to? That's kind of, for the most part, out the window, because you're going to buy it. It's going to be on the market. You're going to know the value because it's already fixed up.
And we talk about this all the time. It doesn't matter the value that much. Like, hey, it's your numbers. It is what you buy it for. Houses aren't priced every single day like the stock market is, right? So over time, it's going to go up in value.
Yes.
Do you know what it is? On the third Tuesday of July? No, that's okay. But long term, it's going to be a great decision. You're going to like what that number looks like.
100%. So what other benefits do you see?
Yeah, I would say benefits to the turnkey side of things. I love the cash flow. I think you could 5x your cash flow versus the BRRRR method.
I could see that.
Cash on cash is a little lower, but that's all right. I love the fact that you're in a very safe loan to value position. So you have a ton of equity built in. So if something did go weird, you have some exit strategies there. You could sell it, get out from under it, wipe your hands clean, and move on. Those are two that come up to mind.
Yeah, no, I think and you're just getting into real estate, and if you're not diversified in real estate, I'm not talking REITs, we're talking ownership. You get the debt pay down, you get the tax savings. This is
simplicity.
The simplicity, and getting into real estate and the money you save on taxes is insane.
Yeah.
Especially for some of these high income earners. I think the best thing for them to do is just to get in this, because the tax benefits, if you do it the right way, will trickle down to your W-2 income. Yeah. So you'll pay less in taxes to the government, because the government always spends their money very efficiently.
You know that.
Yes.
Doge.
Everything that they do is efficient. So not giving our money to an inefficient place would be a good thing.
Yeah, and real estate helps you protect that hard-earned money, no doubt. But some of the drawbacks, turnkey investing, so higher upfront price, so you're going to pay a little bit of a premium because you're not buying a distressed asset. We like to force that appreciation and control the equity in there, so a little bit less control there. And if you're paying 100% cash, you don't get the benefit of the debt pay down. It's only the top end with the market appreciation. But if you're financing, putting 25, 30% down, or using the BRRRR method, you get the debt pay down and the appreciation. So your equity grows on both sides, which is a beautiful thing.
So if somebody came to you with $1 million, would you tell them to pay cash for 4 $250,000 properties, or would you tell them to put 25% down?
It's gonna depend on their goals, right? Do they want to scale, or do they want to ride off in the sunset on the highest cash flow possible today, right? If that was it, probably pay cash for something because your cash flow is going to be the highest. But if you want to build something over the next 5 years, 10 years, I would leverage smart, and I would put 25 to 30% down on multiple different
10
assets.
or 15 of them.
Or one big one, whatever it is.
And
Same
then
thing.
you can also get the tax savings on more properties.
Yeah.
Rather than just the 4.
Yeah.
So
Yeah.
I agree. I think if somebody had $1 million and they're pretty open to like, what do I do? The best strategy to get some cash flow now, to build some long-term wealth, to do all the benefits of real estate, tax savings and everything.
all of them.
I would just say let's put 30% if you want a little more cash flow.
Yeah.
Let's put 30% down
Yep.
on as many properties as we can.
Yeah.
And a year or two from now, you're going to look a whole lot different financially, even though you're probably already financially pretty damn good.
30% is a great medium because you're not 100% financed with the BRRRR method, so your cash flow is way higher, but you're not 0% finance and 100% cash where you lose half the benefit of equity with your debt pay down. So it's a perfect spot to be.
Yep, I agree because real estate's going to go up and down. Overall, it's going to go up, but every month that debt pay down. So it's not a guarantee, I guess, if you have a bad tenant. But if you do it and have a good property management company, it's guaranteed your debt is getting paid down every month. So even if your real estate values somewhat fluctuate, which I just did a post on Instagram, Lucas. I think 5 years in the past 75, real estate's gone down.
So such a great visual.
96% of the years real estate goes up. So even if you're in the little bit time where it goes down, you still get the debt pay down. So your net worth's still going to be
just
going
don't
in a
freak
positive
out
direction.
and hold on. It's going to go back up.
For sure.
Yeah. All right, let's get into some numbers if you're okay. First,
okay.
yeah, I know it's not your favorite. I am the architect here, and you are I forget what he was, but
Architect? What?
yeah, I have a social media playbook now, Sam.
Oh.
I can't talk to you about it yet.
This is a big deal. Okay, you guys. Okay, I see you. That's fine.
Yeah, no, it's really good. But anyway, pretty much using my engineering background.
So I'm the face and the brains and the brawn, and you're the architect.
Definitely not the brains. You are the
Brawn.
Reckless something they called you.
I think the brawn.
Yeah.
I think it's the big muscles is why I'm here.
But I'm going to use my engineering background to kind of break down
Engineer.
some stuff.
Okay.
Right? Okay. So bigger pockets. You heard of them?
I have.
Kind of a bigger name in our space. Kind of the company that really accelerated our education into real estate investing.
Yeah, they were the first ones that got into it after 08 as far as a mass brand and kind of rode that wave up and they were in kind of early on podcasts, which is the best way to grow your audience and grow some credibility. And then they also rode that market wave up, and everybody else is kind of riding their coattails to a certain degree.
No doubt. Okay. Well, they have a quote and a study that talks about the average cash on cash return. That is not the only benefit to real estate.
Correct.
That this is just cash flow. When we're going to talk different types of returns here, we're going to talk equity, cash flow, and tax savings. But just on the cash flow side, okay? The BRRRR average cash on cash return is 15 to 25%.
Assuming you're leaving some money into it.
Assuming you're leaving some money in, let's assume that. In my assumption, I assume we leave $5,000 into it. Okay. But yeah, run it at $1,000, whatever. But a lot of times, we have negative money into the deal, and we get cash back.
And that's a infinite return.
Infinite return. And the average turnkey cash-on-cash return is 6 to 9%, just from the cash flow. Okay. Oh man, I got some numbers for you.
Get it. You're numbered
this
nerd.
This is a house that me and you were buying. Just got under contract.
We're buying a house.
We're buying a house. Hey, we're homeowners. Yes. Our 200 and I think 85th door, not including our office building or storage facilities. So 285th door, give or take, I think it is. It's a house that we are buying for $105,000.
Let's go.
Buying for $105,000. Sam, the house is worth about $175.
Okay.
$175, and it is in really good shape.
Okay.
So that's why I think it's a decent case study for a turnkey investor as well as a BRRRR investor.
Okay.
We're going to spend a little money on it. We're going to spend about $25,000 to spruce it
Okay,
up.
so I have 130 in it?
Yep, we'll have 130 and it's going to be worth 175. That's about 75%. Okay. All the assumptions and the numbers of the monthly stuff are the exact same. I have 3 examples: 0% down BRRRR,
Okay.
30% down, and then cash.
All cash, okay.
All right. So all the numbers are the same. Rents we're going to rent out for $14.95.
Okay.
We are going to depreciate it based on our cost basis. Cost basis is what you purchased it for, base plus your your construction costs. That's what we get
Minus
to
the
depreciate.
land.
Yep, minus the land. So we got the land value at 10%, the building value at 90%.
Yep.
That's what you get to depreciate. Taxes are $16.92 a year for this one. Insurance $950 a year. Maintenance is just a guess, right? It's an estimate based on what we've seen. So we estimate about $150 a month or $1,800 a year, and property management $125 a month or $1,500 a year, and then 5% vacancy. We always take that out. That's what our assumptions are. And your other assumption is that you're in, to keep it very general, the 30% tax bracket.
Okay.
Let's keep it very general. Okay. So this 0% down. All right. So we built in, and Sam, with this BRRRR deal, we're going to leave $5,000 in the deal just to have some numbers to base this also off of. Otherwise, our returns would be all infinite. And that's just not fair.
No, it's not fair to the people.
That's not fair to the people. All right, equity. So we put $5,000 invested in this deal. Year one, our equity is $45,000. Would you make that trade?
I would.
Okay. Cash flow for the year on this one's a little lower than we'd like to, but it's $722 a year.
Okay.
Okay. So speaking of cash on cash return, with that cash flow, you put $5,000 in, you get $722. That is right under a 15% return.
Okay.
So right at our numbers
Still
that
pretty
we
damn
talked
good.
about.
Mhm.
Yeah, 15% return cash on cash. And the tax savings of this deal with the depreciation, we're going to save about $1,200 a year. So actual savings, not lower our income by that. We will save $1,200. We will pay $1,200 less to Uncle Sam than we would not having this rental property.
Okay.
Just one. Okay. Beautiful. So that so the average rate of return and the total ROI on this deal is just insane, right? With those numbers. So what we like to do is we add up the equity, we add up the cash flow, we add up the tax savings. That gives us right under $47,000. You put in $5,000, you get $47,000.
That's pretty damn good.
Pretty damn good, right? That's
like a 5%.
It's an 833 percent return. 833.
That's pretty good.
Is that good?
That's great.
That's good. And over time, we project these out over 30 years because this is a long-term play for us. It's not, and the day one, your rental property should perform the worst.
Mm-hmm. It'll get better.
Yeah, it'll get better over time. Your expenses will increase as this projects.
But rent increase faster than your expenses.
And value.
We've done several studies.
And
yes.
value. So in 30 years, I know it's a long time. Can we do 30? Fuck it. Let's do 30. I said that for no well. This house is the total benefit in 30 years for this one house. $709,000
for $5,000. $5,000 in, $709,000. That was a pen drop.
Is
Don't
that
drop
not
the
amazing?
mic. Yeah, that's how powerful real estate is.
Is that not amazing?
There's nothing else like it.
Yeah.
I don't understand why anyone doesn't think it's the best investment out there. There's nothing else can give you anything like that.
And I'm not saying that's guaranteed, but it's very proven. Very proven.
It'll be near that.
Okay.
If not, it could be higher too, because you probably had real estate doubling in 15 years, maybe, or 18 or something.
Yeah, we have 4% market depreciation, probably right at 15. Yeah.
Okay.
Yep. Love it. All right. Next example, real quick. Prim, 30% down.
A little more quiche.
Quiche. So this is a different.
It's that
type
sweet
of
spot
house.
kind of to me for some
like
of
that
the turnkey
percent,
piece.
too.
People
Yeah.
with some extra money, this is a good spot to be.
I like that 30% down. I was kind of playing with it to like hit some of the numbers that I want to hit or what I think some turnkey investors would hit, and I like 30% for this deal. It could be 20% for one deal, 25 for another, maybe 35 for an asset that's in a nicer area that doesn't cash flow quite as much.
They just need to understand the deal, what it'll do, and we need
Yep.
to understand their situation.
You got it. And so this particular house, let's say it was in a little better condition,
Okay.
and we found it in the market.
Okay.
So we bought this in a little better condition, not us putting $25,000 into it and making it perfect, but nicer.
Okay.
Nicer. So they're not going to get it for $105,000, right? They're going to buy this house for $140,000,
Okay.
and it's going to be worth $157,000, I think.
Okay.
That's a deal. It's not going to be worth $175,000 because it's not brand new, but it's going to be a little more dated, I would say. And we want our turnkey investors to get houses at that 10% discount.
Yep.
So 90% of what
It's
it's
a
worth.
huge discount.
Yep. And so they're gonna buy this for $140,000. Those deals are out there all over the place. We come across them 30 times a month. So they're gonna put 30% down on this. Zero rehab. Okay. 30% down. So putting down $42,000, financing $98,000. Okay. So total cash invested is $42,000 plus some closing costs.
Okay.
Okay. All right. So year one, Sam, they will get put in $42,000 to get $59,000 of equity. they'll get $3,200 a month in cash flow, which is $3,200 a year in cash flow. So yeah, not quite $300
but
a month.
better than the $700 we were getting in cash.
Exactly.
Flow.
So that so it's way more. It's what is that? Almost 4 or 5 times more. But the cash on cash is lower
because they have more cash in it.
Exactly. So they put in 42 to get 3,300 a month. A year. Gosh, I did that again. So that's a 7.55 cash on cash return. Still solid for just the cash because that's only a piece of it, and they're going to get a little more tax savings, $1,300 a year that they're not paying Uncle Sam. So total benefits $63,000. So put in 42 to get 63. So year one, your total ROI is 47%.
That's damn good.
Incredible, right? Incredible. And your average rate of return stays double digits, utilizing that equity for the entirety of this loan, pretty much. And the total benefit on this after year 30 is $736,000.
Yeah, so put in 40 to get whatever, 42 to get to get
736.
Yep.
Yep, that's the game.
Yep, that's a great way to do it, and way less work and effort for the person if they have someone managing it well.
Yep. Let's do the cash one.
For funsies?
For funsies, okay?
So they're going to put all of it cash.
140 buying it cash, all right? So equity is pretty much the value of the thing, right? So it's $157,000 of equity. Put in 40, get 157. Cash flow is my favorite part. So, if your number one goal is like, hey, I want to retire ASAP off my cash flow, the really only great way to do that is to have very low leverage or no leverage. And this is a great way to do it. So cash flow for this thing, after all other expenses that we talked about, is $11,000 a year.
Yeah, that's
pretty good. So you can have 20 of these and be making $20,000 a month, right?
Yeah, more than
give or take. Okay, and then tax savings is the same because you have 140 cost basis. So you put in 140. Total benefit for year one is $169,000. So put in 140 to get 169. That's a 20% return on your money. Cash on cash is 7.85, a little higher than the 30% down. And 30-year benefit is $978,000.
So about $1 million.
Because the cash flow is a little higher every year.
Okay, so $1 million put in a lot more, but you get $1 million.
Put in a 40, but you get $1 million back.
140 to get $1 million.
140 to get $1 million back.
Yep. No,
so I thought those were pretty cool numbers, and these are type of deal. Every one of these deal we would do.
Well, and that's why I think it's important for anyone listening that is wanting to get in real estate that has the extra money. Don't just go buy something off the MLS that your agent buddy brought you. You have to buy it right. You have to understand what it's going to cost to maintain it. You have to have good management because if somebody moves out every year, you're not going to cash flow.
Yeah.
All of those numbers go away if in a 10-year period you have 10 tenants.
Yeah, that ain't good.
So you have to manage it right. It's not just on the front end. So having somebody you trust through the whole process, there's nothing that can beat this.
Yeah, and I think there's just some tips and tricks is if you buy a turnkey property with a tenant already in it, chances are the tenant's going to move out at some point, and just set some money aside for that turnover.
You just got to get with somebody you know.
That initial turnover is going to be the most expensive one, and after that, hopefully, you have a good property management company that can limit that turnover and limit the cost of that turnover.
Yeah, the most expensive part is turnover because you still have expenses, but you're not collecting rent.
You got it, Prim.
I did it. I did it. Thanks.
Your shirt is drying. Sam, we were stuck in a rainstorm. And
monsoon is what I would call it.
Monsoon? They have those around here? St. Louis, Missouri? Okay. And your shirt was like 2 different colors because of it.
It was, I closed the door, ran inside, and looked, and the door wasn't closed. So I had to go all the way back out, close the door, come all the way back in. That's why I was...
How was the door not closed? How does that happen? Did you just forget to close it?
No, I went to close it. It was Matt's Jeep, and he said I would push it really hard to close. So it was just a crack. It wasn't too bad, but I wanted to close it. So
great job.
That's why I was extra wet. Thank you.
All right. So when to use the BRRRR strategy versus when to use turnkey? You want to kind of just wrap it up there?
Yeah, let's do that.
Go ahead.
So if we already kind of alluded this, but I think it's good to kind of wrap this up as far as what you should be doing. So the BRRRR fits you if you have the time, hustle, and either are willing to learn how to rehab or have contractors you can lean on. So you just got to have the time and either experience or guidance, whatever that looks like, to go through the process, because I'm throwing numbers out there, Lucas, but there's 85 steps in the BRRRR method. There's 10 in turnkey.
Yep,
So you're just a lot more involved. And there's a lot of decisions to be made.
You got it.
How far to take the rehab, how to screen a tenant, what bank to go. There's just so many more decisions to be made. So you got to have more time, and you need some type of guidance for both these, in my opinion.
Oh yeah.
And the second one, if you want to build fast and scale aggressively, when you don't have a ton of money, the BRRRR will allow you to. Even if you do have money, the BRRRR allows you to scale much more faster, because even that dude that's got $1 million, he's going to run out of money buying rentals, either cash or 30% down. So if you really want to scale, you got to leverage.
Even to this day, Sam and I can buy 4 or 5 rentals a month and get that system going, and you know, having projects start and finishing and refinancing and purchasing all in this beautiful cycle. With you can't, you know, unless you have an extra 160 grand a month, a month
extra, like not like for your other investments or living or
then you know, that it's near impossible to scale that way with money down investing, which is okay. You don't need to scale as fast on the turnkey side of things because the cash flow is higher.
Yep, 100%. And then you got to be a little bit more comfortable with managing things: the property, the initial purchase, the closing, the rehab, all of those things are a lot more management intensive. So you just need that time that we talked about.
Yeah, turnkey fits. Yeah, I would say.
So this is who fits a turnkey model.
It reminds me a little bit, Sam. Correct me if you don't agree. About the persona or the avatar for a private lender.
Yeah,
that's who it reminds me of a little bit. You
Well,
know, they like real estate, they like the idea of it, but they don't want to get in it because they don't want to go through everything you just said in the BRRRRs, right? But if there is a way to get into it that is turnkey, they can jump in, use their cash, get a return, then it's a no-brainer. And I think anybody would do that who has worked hard in their professional life, has got to a place where they have some discretionary income to put towards places like this. Maybe they're maxing out their IRA already, right? Maxing out the 401k.
Like engineers love to max out your IRAs.
Yeah, heck yeah. And where else are they going to put the money? You're going to open a brokerage account? You know, great. How much money do you really trust to be in the stock market? Same thing with Bitcoin.
And if you want to pull it out, taxes are going to eat you alive.
So this is just a fantastic way for people to diversify that are making good active income that don't want to work forever.
Yeah, and I agree with that. The only caveat I would put is I feel like the turnkey investor that wants to like do a few a year, they are a little more of a high income earner than most private lenders. Like our private lenders are insurance agents that make 120 grand a year, or teachers that have equity in there. It's just a private lender can creatively be like a middle class type of person. Not all of them, but some of them. I feel like the people that can take advantage of this turnkey model are going to be the people that make 400 grand a year, that make 500 grand a year. But they can be private lenders too. So I just want to put that out there. Most people think private lenders are the people that make 800 grand a year, and realistically they're not. But I agree with what you said.
Yeah, and also the people that Sam and I dove into real estate head first, got our hands dirty, learned so much, spent countless hours, days, weeks, years, tons of mistakes. With going into turnkey, you can limit a lot of those mistakes because it's a tenth of the steps, like Sam was talking about earlier. For
sure. What else? It's just newer people that just want a safer, kind of stable income, I think. So, any other turnkey fits?
I don't think so, man. I think that's pretty much the avatar that would be interested in that versus the BRRRR strategy.
Cool. I like it. So basically, real estate's the place for your money or your time or your leverage, whatever you have. Use what you have. If you have time, energy, and are willing to learn and make mistakes, do the BRRRR method if you don't have a ton of money. If you have a ton of money and time, well, good for you, but most people don't, right? So if you have a ton of money and maybe not a ton of time and you still want to get into real estate because you should, then the turnkey model. It's for everyone. We're not going into all of the nuances, but no matter your situation, there's an avenue through real estate.
Yeah, and it's like Sam talked about the chart that he posted on Instagram, or the graph or the table or whatever it was, over the past how many years?
75.
75 years, real estate has gone up in value every one of those years
70.
except for 5, so 70 of them. So it's all about getting in the game.
And two of them were by the way, 1% or 0.5%.
Yeah.
It was 08 through 11 was 08
was 4 of them.
Yeah, 08
or 3.
3 of them. 08, 09, 010 was
010.
And then this isn't 010. Technically is 010, 2010. But that's a holistic median house price chart that I put up there. Obviously some markets went down more than that.
Yeah,
but
no
in general,
doubt. But just get in the game
Yeah.
and let the manage it well, buy it right, manage it well, and let the market do its thing.
Yep.
And then sit back and watch.
Yep, for sure. And if you're looking to do either of these things, we can help. We have a
Yep.
community that helps newbies that want to get in the game, that have the time, energy, and we coach them through. And we have put things together to help the high income earner, high in that individual get into the game. So regardless of what you're looking at, we can help you.
Heck yeah.
But the point is, even if we're not helping you, get some help either way and get into real estate. Whether you have the money, you don't have the time, you don't get into real estate. We'd love to help you, but regardless, get in it.
Mic drop.
Adios, amigos.
See you guys.